Hello everyone and welcome to Fun with Fitzy. We are on 9.5 part 3, declining balance depreciation. By now you should know how to do straight line depreciation. So right now it's just how to calculate the depreciation expense that changes. The depreciation journal entry remains the same. The declining balance method is an alternative method to calculating depreciation. There are several methods. In this course we're only looking at these two. The declining balance method is common because the Government of Canada requires a variation of this method for income tax purposes. So this method calculates the annual depreciation expense by multiplying the remaining undepreciated cost. It's what you haven't done. This is the net book value. Remember, cost minus accumulated depreciation, and we multiply it by a fixed percentage. So in this case, salvage value or residual value does not matter. Ignore it. If it's given to you, ignore it. Okay, so there's a formula. It's going to be depreciation expense equals net book value times rate. That's it. Some of the percentages rates set by the government as follows. Now, this is a CRA table, Canada Revenue Agency, and they call it capital cost allowance, which is depreciation. And they have different classes of assets, but basically we're looking at the rate. This is what we need to put in our formula to calculate the depreciation expense. Okay, so let's look at some examples. You purchase computers on January 1st for $22,000. This is your cost. The rate per the previous slide, the rate for the computer is 30%. Okay, so let's look at that again. So here's our cost, and here's our 30% because we bought a computer. And on January 1st, this is still important. Remember, always look at when we had it. So we're assuming we've had this for a full year, so we do not need to prorate. So the depreciation expense will be calculated as follows. Remember, the formula for depreciation expense is net book value times rate. So the cost was $22,000. Remember, our formula for net book value equals cost minus accumulated depreciation. Because it is the first year of this asset's useful life, we have not accumulated any depreciation. So in year one, net book value equals cost. So we're going to take the original cost and we're going to multiply it by that 30%. So here's our formula, net book value times rate. And so it's going to be 22,000 times, and when you plug it into your calculator, it's going to be 0.3, right? So 22,000 times 0.3 equals $66,000. So here's our depreciation expense. This is what we're going to put into that depreciation journal entry that first year. And on our balance sheet, we would have $22,000 as the cost of this computer minus our depreciation or accumulated depreciation of $66,000 because it's our first year, to give us an undepreciated cost, which is the same as saying net book value, of $15,400. In the next year, because our formula is net book value times rate, we're going to take our net book value, which is $15,400, times it by our rate to get $4,620. And therefore, once you subtract that depreciation, we're going to get a net book value of $10,780. I'm going to show you how to put it in a table in a minute because it's much easier, but that just gives you an idea. Okay, we're going to look at partial year depreciation here. So now we bought a computer on March 1st. We did not have it for the full year. 2006 for $22,000, we know from the CRA table. So we know the CRA rate is 30%. So according to our formula, we know our formula for depreciation expense is net book value times rate. Net book value times rate. So because the first year, we know the net book value equals cost, because net book value's formula is cost minus accumulated depreciation, and there's no accumulated depreciation, then that's our net book value. So net book value times our rate. But here's the proration. We got it in March. So we had it for all of March, April, May, June, July, August, September, October, November, December. Now I would say use your hands, but I don't want to draw my hand anymore. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. We've had it for 10 out of a possible 12 months. So plug this into your calculator. 22,000 times 0.3 times 10 divided by 12. And you're going to get 5,500. That's the depreciation expense in the first year. Okay? Now I'm going to talk to you about the 50% rule in a little while. But for now, we're going to just prorate it if you're just doing declining balance partial year depreciation for your company. But when you need to submit to the government your depreciation, you need to use the 50% rule, 50% here, no matter how long you've had it for. And our net book value then is our cost minus our accumulated depreciation, in this case 16,500. The next year then, we don't need to do this because we've had it for the whole year. So we're going to take our net book value, because our formula is net book value times rate, times it by 30%, which is 0.3, and we're going to get 4,950. Let's look at it in a table. It's much easier. Okay, so we have an automobile purchased for $25,000. Use a CRA rate of 30%. So 30% is going to be our rate every year. I encourage you to make these tables every time. So here's our years. 1, 2, 3, 4. We're just going to go for 5 years. Our net book value at the beginning of the year times rate is our formula, which will give us our depreciation expense. So net book value in our first year is going to be our cost, because there's no accumulated depreciation. So $25,000 times 3% is 7,500. Because that is our expense in our first year, we've accumulated $7,500. And now our net book value, remember our net book value is cost minus accumulated depreciation. So cost minus accumulated depreciation, which is right here. So our net book value at the end of the year is 17,500, which, if the net book value at the end of the year on December 31st should equal the net book value at the beginning of the year, January 1st, right? So again, now let's do our depreciation expense. And that was January 1st, so I did not have to prorate the first year. So 17,500 times 0.3 equals 5,250. Now, in order to calculate our accumulated depreciation, we're always going to do what we had plus our new depreciation. And our net book value, cost minus accumulated depreciation. So my cost was 25,000 minus now my new accumulated depreciation equals 12,250, and so on. I'm going to bring this 12,250. I'm going to times it by 0.3. It's going to give me 3,675 to get my depreciation expense. You'll notice the depreciation expense is different each year in the declining balance, whereas in the straight line, it's generally the same, except for the first year if you prorate. Now I'm going to add my accumulated depreciation in year 2 to my depreciation in year 3 to get now my accumulated depreciation in year 3. 16,425. Net book value is cost minus accumulated depreciation. Cost minus accumulated depreciation. So 25,000 minus 16, $8,575. And that becomes our net book value in the next year. Oh my gosh, I'm dyslexic. Okay, and so on. 8,575 times 0.3. And our next year is going to be 2,572.50. and so on. We're going to add this up to get that, and so on and so forth. You will notice our depreciation expense gets smaller and smaller each year. That's why we call it the declining balance method, in case you're wondering. The depreciation expense declines. So if you were to graph it, like we did with the straight line, we would have depreciation expense on our y-axis and time on our x-axis, these are in years. We would have it going lower and lower. So it's a declining balance depreciation. Whereas a straight line, remember the table goes straight across like that. So that's it. I'm not going to finish this table in respect of time here. Try it on your own. I want you to answer the following question. So here we have a building purchase for $400,000. January 1st, so you do not need to prorate. Complete an amortization table for the first 4 years. You're going to answer the following questions. What is the expense year 1? Accumulated depreciation year 3, and the net book value after 4 years. Press pause, make your table, and come back. Okay, always start your table with net book value, then rate, because here's our formula, right? Net book value times rate equals depreciation expense. Right, that's pretty much our whole formula right there. And this is what we're putting in our journal entry every year, this number right in this column. So how do we do? 400,000 is the cost, but because it's the first year, it's also our net book value because there's no accumulated depreciation. So 400,000 times 0.1, which is our rate. So our depreciation expense is 40,000. We do not need to prorate because we had it for the whole year. Our accumulated depreciation is, remember, 0 plus 40,000 equals 40,000. And our net book value, cost minus accumulated depreciation. Our cost was 400,000 minus 40,000 is 360. This becomes our net book value at the beginning of next year. This times 10% equals $36,000. And then to get our accumulated depreciation, we're going to add the 40,000 plus our new depreciation expense, which will equal $76,000. And our net book value is cost minus accumulated depreciation. Here's our cost. 400,000 minus the 76,000 equals 324, which is the net book value at the end of the year, which means it's the net book value at the beginning of the year. Times it by our rate. Here's our new depreciation expense for year 3. By the way, let's put our years in. And again, accumulated depreciation, you add the previous years plus the new depreciation expense, and we're going to get this, and so on and so forth throughout the table. So what were the questions we had to answer? What is depreciation expense year 1? Well, this is our first year here, our depreciation expense year 1. What is the accumulated depreciation year 3? Well, here's year 3 and our accumulated depreciation year 3. What is net book value after 4 years? Well, this is our 4th year at the very bottom. There's our net book value after 4 years. So it's much easier to answer these questions when you put it in a table. So now you should be able to calculate declining balance depreciation, prepare an amortization table, prorate, I don't have that in here, for partial year, and journalize. We already know this, right? So let's go back to our table, do a quick example. So the journal entry this year would be debit depreciation expense, $40,000, credit accumulated depreciation, $40,000. Okay, hope that helped, and we'll see you in the next video.